General Motors' facility in Oshawa, Ontario, is the latest Canadian auto plant to feel the effect of US tariffs. Amazon Jeff Bezos sources telling CNN that the president at one point wasn't happy earlier today. One by one, Canada is attracting trade partners that have broken away from the US with a massive $214 billion deal. Canada has stunned everyone in today's turbulent global economy. The move has turned the USC-Canada trade relationship, which had seemed stable and robust for years, on its head. While the United States struggled with tariffs and isolationist policies, Canada forged new ties in different parts of the world and opened the door to a whole new era. So, what does this trade war change for the US economy? Which sectors from agriculture to manufacturing are being hit by Canada's expanded global network? We will examine the details of the latest developments in the world together. Don't forget to subscribe to our channel, turn on notifications, and like to stay up to date with our content. For many years, Canada has relied on the United States for almost 34 of its exports. Historical ties, mutual reassurance, and geographical proximity had created an unshakable sense of friendship between the two countries. But Washington's harsh tariff policies, which began in 2023 and became more pronounced after 2024, quickly shifted the balance. President Donald Trump's aggressive tariffs, which were more aggressive than in his first term, and nearly double tariffs on steel, aluminum, and automobiles, shook the market to its core. When the tariffs on Canada first reached 25% and then 50%, the traditional course of trade suffered a major break. This was also made tangible by Canadian Prime Minister Mark Carney's outspoken declaration during his visit to Washington. The old relationship is over. The dissatisfaction that had until then been discussed behind closed doors was suddenly voiced in front of the whole world. Everyone from small and medium-sized companies to giant factories started to get nervous because tariff increases of up to 50% were not harmless for any company. When Canadian steel producers informed US buyers that their prices would double, it was clear that this was no bluff. The final straw, as the famous expression goes, was the threat of a tax on Canadian energy. Because Canada is a critical player in the supply of oil and natural gas to the US, no one envisioned a tax on this area. However, the rhetoric of a tax started to fly in the air, leading companies to wonder what other surprises will we face in the future. Thus, Canada accelerated its expansion into different geographies instead of moving away from the US, its biggest customer. Towards the end of 2024, giant trade agreements in Asian and Latin American markets came to the fore. The Comprehensive Economic Partnership Agreement with Indonesia, a country of 280 million people, was a key example of this new era, covering a wide range of sectors from electronics to mining and eliminating 90% of tariffs. This agreement tied Canada much more strongly to the Asian market. At the same time, Ottawa doubled down on its Indo-Pacific strategy, announcing a $2.3 billion support package, proving that its presence in the region would not be accidental but systematic. While all this was happening, the picture in the US was different. As usual, producers, farmers, and consumers felt the sudden surge of tariffs. Business leaders in states from Michigan to Missouri sent letter after letter to the Trump administration. Auto industry titans worried that vehicle prices would rise by thousands of dollars, undermining consumer demand, and tariffs on steel from Canada and elsewhere have sent US steel distributors' costs spiraling out of control. The future of mill workers became uncertain. Farmers began to look for new markets, fearing that retaliatory tariffs could target their crops. There was only one question on everyone's mind: who will pay for these trade walls? The answer was clear: US businesses and end consumers alike. Canada, on the other hand, was promoting itself as a safe harbor. Unlike the US, which retreated or became unpredictable, Ottawa promoted the slogan, "We create predictability." This slogan was not simply an advertising promise, but a political, economic, and diplomatic strategy. Canada quickly expanded agreements with global players such as the European Union, Japan, Australia, and India. Foreign investors realized that it made more sense to open a campus, set up an R&D lab, or build a factory in Canada rather than face uncertainty in the US. That's why FDI inflows to Canada increased by 9%, while investment in the US fell by 28% over the same period. In Canada, billions of dollars of new resources have even started flowing into battery and critical minerals projects. In the US, the agricultural sector in particular has been squeezed. Citrus growers in Florida, bourbon producers in Kentucky all felt the impact of retaliatory tariffs or difficulties accessing the Canadian market. As extraordinary tax hikes hit key sectors of the economy, the business community began to ask, why is Washington acting so aggressively? In the political arena, some political advisers made veiled jokes, such as, when Canada becomes our 51st state, we won't have to worry about taxes. But this did not make Canadian officials or global investors laugh. On the contrary, Canada has started to reap the rewards of presenting itself as a safe, stable, and rules-based market from Europe to Asia, with the idea that if America builds walls, let's build bridges. 3. In the midst of all this, a giant $214 billion trade agreement has dominated the agenda. This multi-sectoral package, which Canada has signed with new partners in Asia and Latin America, is weakening the United States' traditional partnerships. Experts are calling it the biggest policy failure of the decade, because the US is not only penalizing foreign producers, but also forcing domestic buyers to look for alternatives. President Trump's tariff campaign, which has continued to escalate in the following days, has hit the automobile and energy sectors particularly hard. The North American Automotive Manufacturers Association announced that the impact of the tariffs on vehicle prices has begun to fall on the backs of both consumers and, for US consumers, the announcement fueled concerns at a time when grocery bills and gasoline prices are also rising. Not only large corporations, but also small businesses are complaining about the rising cost of doing business. Some are turning to markets outside the US or looking for ways to shift production from Canada to Mexico. But it is important to remember that similar tax tensions exist in Mexico. These trade tensions are not limited to the USC relationship. While the US is trying to curb imports by imposing tariffs, countries like Canada, which pursue softer policies, are also expanding their share. While the Canadian economy continued to grow by 2.6%, export growth on the US side remained as low as 1%. The gap is wide, ranging from agricultural products to industrial goods, from automotive parts to pharmaceuticals. At a time of US protectionism, Canada's appeal to European producers coincides with its message that our market and our agreements are open to everyone. This message has led to a series of economic cooperation agreements. These include agreements on critical minerals, green energy, artificial intelligence, and advanced manufacturing. In fact, Canada's historically US-dependent economy is undergoing a transformation of its own, and Washington's tough stance has accelerated this transformation. Time will tell whether this is a case of Canada winning, the US losing, or whether this process will lead to a renewal of both sides in the long run. Some analysts emphasize that these steps taken by the US to protect its domestic market will boost some domestic sectors in the short term, but in the medium and long term, the cost of losing important partners will be heavier. Global companies that have deepened their trade networks over the last decade do not like it when a country suddenly starts building walls. This is because issues such as supply chains, joint R&D projects, and capital flows need stability and predictability. This is where Canada's emphasis on predictability is critical. when Trump woke up one morning and raised the steel tariff from 25% to 50%, or imposed a 25% tariff on automobiles. It upset the strategic planning of companies. It's no wonder that even Canada is increasingly turning away from the US. The US is self-destructive, but we can't stand by and let it bring us down, say representatives of major corporations in Ottawa. According to the World Bank's 2024 report, Canada is increasing its integration into global trade networks, while the US wants to return to a more protected model. The question arises when the trade war escalates, how will it affect everything from consumer prices to the industrial supply chain? Time will tell, but early indications are that Canadian producers are aggressively expanding exports to Asia and Europe, while partially protecting their share of the US market. So, what do you think about this? Let us know what you think in the comments. Please don't forget to subscribe to our channel and turn on notifications to be informed about new videos.